respecto a las subidas de tipos de interés. ¿En qué entorno nos vamos a estar moviendo en ese aspecto? Bien, pues saludamos a Edward Williams, multi-asset specialist in Alliance Bernstein. Edward, thank you so much for having us a few minutes.
Thanks for having me.
Edward, coming out of challenging 2023, 2023, but 2023 is it too? Market seems to have started this year on the front roof. What's driving this right now?
Yes, that's right, and it's really a story that started in the fourth quarter of last year and has continued into the early stages of this year. We've seen markets respond very well to softening inflation data in the US in particular, which has given investors hope that we might be moving closer to the end of what has been a historically aggressive hiking cycle from global central banks. So to add to this, if we think about the US really is setting the monetary policy environment for the rest of the world, then we can think about China as having a very large influence on the growth environment. So the reopening of China to the rest of the world post-COVID was also received very favorably, and this should really drive kind of increased demand and activity across the global economy. So this has been a strong tailwind for markets in recent weeks and emerging markets in particular.
And of course, we have to mention inflation in all this great picture of markets. Where does it go from here?
Yeah, of course. I mean, 2022 was a year defined almost entirely by inflation, and any sensible market-focused discussion for this year should begin with inflation as well. And that's because it's still too high, and if it doesn't normalize, all other factors will largely just be noise. So the view from the team here is that we expect inflation to decline over the next few months, and the pace and extent of that decline will largely be determined by each economy's exposure to different components of the inflation basket. Goods inflation has really started to moderate, and significantly so from the levels seen in the early parts of last year when supply chain disruptions really dominated the global landscape. So with these issues largely healed, goods prices have really fallen over the past few months. I think it's on the services side where things are a little bit more tricky. While we've seen some relief coming for shelter inflation, wages remain kind of the key driver of that basket, and this is the case in both Europe and the US. Wages are really kind of the biggest cost input for most services industries, and that's why we see the two kind of move so closely together through time. If we are going to see wages cool, then central banks will need to tighten policy to slow growth a material amount, or even possibly induce a recession. Even with the aggressive hiking seen last year, there's not much evidence of wage cooling, with labour markets remaining exceptionally tight across the globe.
That's important to look at wages and its evolution and probably solution from central banks. So what does this mean for interest rates?
Well, I think it's these tight labour markets that will force central banks to keep raising rates. I think while we're confident about slowing inflation in other areas, we are less confident about wage inflation. So until the labour market weakens materially from where we are now, I think we're unlikely to see rate cuts, and I think that's why we think, kind of as a house, that central banks will pivot more slowly than financial markets seem to be pricing in. So if rate cuts happen, we don't think it will be until the end of this year, maybe into 2024 or further down the line than that.
I understand, Edward, you look at things from a multi-asset perspective. What does this backdrop mean for your investors?
Yes, that's right. So I think, well, the good news is, and as you mentioned at the beginning of this call, is that markets have started very well this year. And in fact, it's been the best start to the year for a classic 60-40 multi-asset balanced portfolio since the 1980s. So what does that mean for us? Well, even with a very good start to the year, but valuations across both equities and debt markets are at levels that historically have set up quite strong forward returns. So we think that there is some potential there for further upside. I'd say perhaps more importantly, the dislocations seen in fixed income markets over the past year, while very painful, have helped to reassert stock bond diversification properties. And that's something that really broke down last year. And this kind of reassertion should improve risk-adjusted return prospects for multi-asset investors like us.
Where should, with this context, investors look for opportunities right now?
Well, as you mentioned, I think we look at things from a multi-asset perspective, and more specifically, I'm focused on portfolios that are designed to generate income. So across our portfolios, we've got exposure to high yield credit, where we're getting kind of very, very attractive levels of income, around 8% on something like US high yield, for instance. And that's really in a market where fundamentals remain very healthy. Balance sheets are in much better shape than they have been in previous late cycle environments. But I think what's important is we need to be selective in this market. We've seen valuations come in a reasonable amount in recent months. And if we are to see some form of protracted downturn, then there are certain issuers that could suffer. On the equity side, we continue to like dividend payers. Again, valuations in this market look attractive here versus their own history, but also versus the broader equity market as well. I'd say outside of this, maybe more on a tactical basis, we like emerging market equities, which have started the year very much on the front foot. And we see further support for EM companies coming from this sort of global disinflationary environment, a softening US dollar, and of course, the reopening of China, which is the largest part of the EM equity benchmark by some distance.
And according to you, which are the key risks that we should look at this moment, taking into account this general picture of markets?
Well, while not our base case, or indeed the market's base case, a deep recession is the key downside risk. Should we see central banks tighten monetary policy too far, to a point where economies meaningfully slow, this would create challenges.
And Edward, just to finish, where do we go from here, and what is important for asset allocators?
Well, what does this all mean for investors? Well, I think the good news is that 2023 probably won't be as challenging as 2022. Even if inflation falls only gradually this year, it'll take the pressure off interest rates, especially since we think that rate hikes will largely wrap up in the first few months of this year. An end to this kind of hiking cycle should provide relief to both stock and bond markets. However, it's our view that it's too early to sound the all clear. A world with slow or negative growth and what is still quite restrictive monetary policy is hardly a favorable environment for financial assets, and we should expect to see some volatility moving forward. I think we'll see markets rally when inflation is softer than expected, and on the flip side of that, we'll see markets sell off when inflation surprises to the upside, or if we get more kind of hawkish rhetoric coming out from central bankers. I think in terms of what's important for asset allocators, I think in this environment, we think it's very important for investors to stay diversified. I mentioned earlier how we see the diversifying properties of bonds returning, and we think that will be particularly helpful if we see a meaningful slowdown or recession. We think it's important for investors to focus on quality. That's quality companies with strong pricing power, and they often demonstrate consistent profitability even in inflationary environments. So we usually find firms like this in more traditional defensive sectors, places like utilities or consumer staples. I'd say finally, I think being flexible is key. I think as multi-asset managers, we use a very broad sort of research toolkit to identify when the environment is maybe more or less conducive for taking on risk. So we really think that kind of being active with your asset allocation decisions can make a meaningful difference to your portfolio's returns over the long term.
Being active and flexible with all these multi-asset strategy decisions. Thank you so much, Edward Williams from Alliance Bernstein. As always, a pleasure.